you very much. Thanks for this great conference, and thanks also for inviting us. So Scott and I were at the Office of the Chief Economist at CFTC, and we are delighted to be, as derivatives regulators, we're delighted to be here representing CFTC. So, hold on. There we go. So we have a disclaimer. Basically, everything we say here is our ideas, nothing can be attributed to the commission. All right, so motivation. What we're going to talk about really in this paper, the story is about liquidity provision and risk management of intermediaries, especially the risk management part of it. Right? There's a lot of research that shows that one, intermediation by dealers is very important, but the fact that risk appetite of dealers, right, for our paper, that actually is important for how well they can do intermediation and service their client demand. Why? Well, because the intermediation dealers might have to warehouse some risk, and they might actually take on some basis risk, which is what we're going to show. So this whole risk-bearing capacity of dealers is important for also asset prices. We choose, for our setting, we choose WTI, crude oil space, because one, we are the derivatives regulators, and we have data on the swaps as well as the futures. And swaps and futures for WTI are both quite large, and we know, and we will show that the dealers that are making markets in the swap space actually go to the futures to hedge some of that exposure. And there are a number of players in this space. So we have the swaps dealers, and there are also real economy clients, right? So these clients, these fuel producers, they actually prefer short exposure in long-dated contracts. And then we have index investors in the space which prefer to go long in short-dated contracts. So if you will, dealers are taking all of that exposure and doing some sort of a maturity transformation. And I'll show you that it's not going to cancel out each other. So they're going to end up with some net swaps exposure, which then they take it to a futures market. However, in the futures market, because of the liquidity and other reasons, they're going to end up with some basis risk, and that's important, and it's especially important as their risk appetite changes throughout time. Very high-level key conclusions. One, we want to show that, look, swaps data is important if you want to look at the energy derivatives markets. Two, in our work, we can control for demand side effects and supply side effects, especially coming from risk appetite. And we show that the futures positions of dealers mirrors their swap risk exposure, right? Dealers are long in the short-dated futures and short in the longer-dated futures contracts. And they do tend to hedge their positions more tightly in the latter part of our sample. And we claim that there is also a decrease in risk appetite. And we also look at sort of the heterogeneity across the hedging ratios of these dealers. And we show that there is heterogeneity, and the heterogeneity even changes throughout our sample. Okay, very quickly, there's a good amount of literature that we benefited from, but let me just mention two of them. One, our discussant Lars has a paper with Viral and Tarun, and they do a great job of looking at the futures market where there's producers who have a hedging demand, and there are speculators. And the risk premium and the changes in spot prices are affected by the producers' hedging demand, as well as the speculators' ability for capital constraints on the speculator side. And obviously, we have a lot of good papers that we tie into, such as Nike and other papers. But one other paper I want to mention is also Tula, because they also bring in risk appetite, which is also sort of a pivotal for our paper, and how risk appetite also by brokers and dealers actually affects risk premium in the market. Okay, so I just want to take more time with showing you some data, some of this new data that we have. All right, so we're going to combine three main data sets. The main data set we have is actually the swap positions held by 26 dealers from 2007 to 2015. Now you'll notice that it starts in 2007, meaning this is all before Dodd-Frank. Currently, we receive some swaps data, transactions, some positions, but this is all before that. So what happened is towards the end of 2000, or in the middle of 2017, our commission, CFTC, decided to reach out to certain swap dealers, the major swap dealers in the market, and ask them for their swap exposures. And this was what we call a special call. So it was not necessarily done on necessary rule, but there were a handful of generally 26 dealers that were contacted, and they started sending us data on a monthly basis up until almost the end of 2015. So Scott and I, we decided that we could use this data because it's interesting and it's you know, it covers a good span of number of years. And what we see here is that we see their single commodity swaps on WTI, and also their WTI exposure through commodity index swaps. And one thing to note that's important here is that all these exposures we get, we actually also receive them in terms of delta adjusted futures contract basis. So that allows us to take whatever data they send us and then go to our futures market data, which is, many of you know, the COT, the Commitment of Report, Traders sort of reports, well, the data underlying that, and merge those together. So all we had to do was identify those dealers in our futures data, futures and options, and we were able to net them very quickly just because everything is reported as in futures basis, contracts basis. And then we also collected some publicly available balance sheet and trading book data, mainly for control variables, but also for risk appetite. Okay, so here's some graphs. I would probably say this is maybe the most pivotal graph. If anything, I would urge everyone to pay attention to this. And when we saw this graph with Scott, we looked at it on dealer by dealer basis, it was quite eye-opening because the black line here is this net swap position by dealers. And the dotted blue line is the net futures position. And obviously the thing that we noticed right away is the high negative correlation between these two, right? The first part of the sample, net swap position is negative, net futures position is positive. Then around 2010, 2011, it switches. And then in the second part, we see net swap position being positive and net futures position being negative. So this really gave us the idea that, yes, they swap dealers, we were suspecting it, but swap dealers, we think, are really using futures for hedging purposes. And now in this one, what we do is we actually break out this net swap position into index swaps and WTI swaps, right? And this gives us a little bit of why it switches from negative to positive. In the first part of the sample, the index swaps, which are negative on the swap book of the dealers, are larger than the WTI single swap commodity positions on the book. And then in the second part, what happens is that index swaps get smaller in size and the net WTI swap positions get larger. So as overall, the net position of these swap dealers in the book, their swap exposure goes from negative to positive. So we have some interesting variation in terms of their swap book, how it changes throughout time. And I'm just going to briefly mention that basically, initially we wanted the commission reached out to certain swap dealers, and there was a de minimis number, meaning that you have to be holding certain amount of contracts to be so that our commission could reach out to you. So as you can imagine, there were some new dealers that came into swaps, that came into our special call, and some of them dropped, and some of them even dropped out of business, as we know. So throughout time, there was some variation in terms of the number of dealers that we collected data from, just to point that out. But overall, we have about a 26 dealer sample in our total sample. Okay. We have a brief theoretical model mainly to motivate our empirical analysis, and I'm not going to get into too much detail in this, just 3 slides, I promise. But for more information, you can go to the paper. And what we're trying to do is model the swap market and the futures market. We have 3 main market participants. So we have producers, which are, they have some exogenous need to hedge, and they're going to hedge their endowment in the swap market. And there's swap dealers who are taking the other side of these producers, but swap dealers also have access to the futures market to hedge their swap exposure. And there are futures traders that are only going to trade in the futures market, and all of them are mean variance optimizing agents with risk aversion parameters. And then just to make things easier, we add some exogenous index investment, which we assume only takes place in the futures market. So this is our basically swap market equilibrium. Again, not to get into much detail in terms of math, but what we find is that the swap dealers are going to be, there's going to be higher swap demand for swaps, or the swap dealers swap book is going to be larger if producers are endowed with more commodity or index investment increases, things like that. But the one thing I want to point out is the one that's in red, which is that dealers' risk appetite, because that the things in red are the ones that we actually kind of try to take the data and then test it. So we want to focus on a little more is that dealers' risk appetite also has consequences for the swap book, and I'll show you some empirics on that. And then the futures equilibrium. Again, what we care a little more about is the dealer's hedge ratio, right? Number of futures the dealer would short against a certain swap position. And what the model predicts is that dealers are going to be hedging more tightly if the dealer's risk appetite declines, or the futures contract improves as a hedge. And here in the model, it's captured as the rho, which is the correlation parameter between the swaps and the futures. And that becomes actually important also, I'll show you in the empirical part. There's also another finding that the futures trading becomes less costly in terms of market impact, but we think that that's not as relevant for the empirical part. Okay, now let's jump onto data so Patrick doesn't yell at me for going out of time. All right, so main descriptive statistics. I know there are a lot of numbers here. I just want to guide you through a few of them, and I want to spend some time on this because this kind of data is the first time people are really looking at it. So top panel, what we really have is, again, this dealer swap positions or swap book, net index, net WTI, and the total net swaps, right? And we divided our data into two samples. One of them is 2007 to 2011. The other one is beginning of 2012 to 2015. And the main reason is that the first period captures somewhat of the financial crisis plus the starting of Dodd-Frank, but the rules were not written yet. And the second period actually captures more of the rules being implemented. So we think that there's differences in these two periods. And the arrows just point out how things have changed through these periods. Right, so the net index exposure went down, which we also saw in the graphs, and net WTI exposure went up, actually increased. And as a result, the swap book went from negative exposure to swaps to positive exposure. Somewhat interestingly, if you look at the gross numbers actually in the swaps, everything goes down. So the gross swap business kind of decreased throughout the sample, whether it's index or WTI. Then we focus on the some market variables from the futures side. And we show that, okay, so futures prices didn't change too much, but volatility, implied vol, went down, and production forecast went up. So there's more production and less volatility, and maybe that's why total swap, gross swap hedges were not as high as expected. And if you look at some of the dealer fundamentals, you'll see that leverage is going down, aggregate and commodity VARs are going down, so there is some sort of lower risk appetite, if you will, and that becomes somewhat important in some of our regressions, actually. Okay, what does the future side look like, right? So this is this is actually starting to give us some of the first clues about how these dealers were hedging, and let me highlight some of these things. So the first box, the small one, so first of all, we took our futures and options positions and divide them into the front part of the curve, which is 0 to 3 months, and then the further out in the curve. And what you see immediately is that the front part is positive, right? The numbers are positive. They're going long in the short futures. And if you look at anything 3 months onward, they're actually going short in the longer dated futures. And this actually lines up with, mirrors what we've seen in their swaps book. And if you look at sort of from the first period to second period, again, the first period, their futures exposure is positive, and then they go short in the second period, again, mirroring the switch in their swap book. And if you want to look at, instead of nets, if you want to look at just open interest, open positions, what they're holding, you will see that overall, again, this decrease in their futures open position, which also lines up with their change in their open position in the swaps book. So overall, less swaps business, less hedging maybe, but also their hedging switches around from period 1 to period 2. Okay, so all of this to build up to say how is risk appetite of dealer, how is risk appetite and dealer swap books are related. So we tried to first understand that, and we're looking at here, so that the dependent variable is the dealer swap book, and how is that affected by risk appetite. And we have a bunch of, again, following Lars's paper, we have a bunch of control variables we tried to put in there, producer Z-score and futures prices, TED spread, and other stuff. But the main thing I want to point out is that we also want to include risk appetite and see how risk appetite is associated with dealer swap book. And in this case, we use a number of different proxies for risk appetite, from leverage to VAR to commodity VAR and others. And we also put an equity there. But overall, the significance and the sign tends to come out about the same for almost all of them, basically saying that risk appetite matters for the swap book. Bigger risk appetite for dealers means bigger swap book, or is associated with bigger swaps book. And if we had to put economic meaning, I could say one standard deviation increase in equity is about almost 6,000 contracts increase in swap book. And similarly, one standard deviation increase in leverage is about associated with about 3,500 contracts increase in the swap book. Now, in the second regression, we actually kind of we swap some of this the way we look at it, and we have the dependent variable, we have the commodity VAR here, and we're regressing in a number of other variables, but maybe the important thing is, again, what I highlighted, which is this trend variable. Okay, so no matter how you really look at it, whichever specification you want to look at, the trend tends to come in significant and negative, meaning that throughout the time of a sample, we actually observe a decrease in the risk appetite of these dealers, and this is even true when we control for their swap book. So this all begs the question: how do dealers really manage their risk exposure? So how do they hedge their swap book? So for that, we run a simple regression, and I'll walk through some of these findings here. But basically, we're regressing their change in their futures, net futures exposure to index swaps and the WTI swaps, right? So first things first. We also separated by futures and options, and futures and options together. First thing is that, look, we get most of our significance, if not all, from the future side. There's not much going on for options. We're going to assume that, which tells us that they're not really using options to hedge their swaps book. And then if you look at, again, just the futures and look at index swaps versus WTI swaps, you see almost one-to-one hedging in the index swaps, but hedges are not as tight in the WTI swaps. And which kind of makes sense because index swaps are short-dated, and in the future side, the liquidity is really on the shorter side of the curve, so they're able to hedge that rather easily. In the longer side of the curve, liquidity is not as much, which is what you really need to hedge the WTI swap exposure. Hence, you have some basis risk, and you're not going to be able to hedge it one-to-one really. The other thing we see, again, is that if we look at different parts of the curve, futures curve, we're going to see that the 0 to 3, maybe in 3 to 1 year part matters more for the index swaps, and the further out part of the curve really matters for hedging in terms of WTI swaps. And what we show here is that, again, if you look at these coefficients and want to have an economic meaning, we show one standard deviation increase in index swaps translates into 15,000 contracts of a hedge in the futures world. And for WTI or single commodity swaps, it translates into almost 20,000 contracts. So these are huge numbers, actually. Next, what we try to do is we try to look at the dealers. We run a regression, similar regression on dealer by dealer basis. And here we're showing you the distribution of our coefficients, because we want to understand is how much heterogeneity is there across dealers. How are they hedging? Because these different dealers are of different size, actually. So we run our baseline time series regression for each dealer, and we're showing here sort of the distribution of the coefficient for the index swaps and the WTI swaps. And again, what you see is that there is quite a bit of heterogeneity in terms of the coefficient, the betas for the index swap and the single commodity swaps. And as expected, because we've seen in the previous slide, the coefficients seem to be tighter, closer to -1 for index swaps than WTI swaps, but still we do observe both sides. There's quite of heterogeneity. The next thing we did was, knowing that there was some shift in terms of how they're hedging from period 1 to period 2, we want to allow for these coefficients to differ between these two periods. So we run these regression with dummies, trying to see how coefficients changed, again, for each dealer, and then showing you the distribution. And as you can see, tried to point it out with arrows, that everything gets tighter. And if you look at the distribution for either one, index swap or WTI swaps, everything gets a little closer to -1 and tighter. And this is again true for index swaps and WTI swaps. And
Listen, you have about 3 minutes left. Just
sure. Yeah. Thank you. And what you see is that, again, hedge ratios do vary, change across dealers in the latter part of the sample too, but maybe not as much. I mean, I'm not reporting the entire quantile range here, but you can eyeball it and see that basically the heterogeneity across dealers in terms of how they're hedging tends to diminish in the second part of the sample. And I'd like to show you one last thing. I think I'm going to be on time. What we want to understand is kind of take that last set of coefficients and see if we can run a regression trying to understand how they fit. So what we're doing is, on the left-hand side, we're looking at the change in the coefficients from period 1 to period 2, and regress on the period 1 coefficient. And basically what we're showing is this, that there is some sort of a golden ratio of hedging, that these, for index swaps and single commodity swaps, they're separate numbers, but there seems to be something like a golden ratio that they like. And in this case, in the data, it tends to be around -1 for index swaps and -0.6 for single commodity. And if you were over hedging, if you will, if your coefficient was higher in magnitude, or it was around -2, you will tend to move towards this golden ratio of -1 for index swaps. And if you were under hedging, you actually, after in the second period, you tend to move towards, again, this more golden ratio of hedging. And similarly for single commodity swaps, except that golden hedge ratio is slightly different. Okay, so key conclusions. We know that recent research suggests that role of intermediaries are important for asset pricing implications. And what we're saying is that, look, full picture of swap and futures holdings is really important and required, really, to understand the balance sheet of these intermediaries. And we tried to control for demand side effects, looking at the quantity of crude oil to be hedged by producers, and supply side effects, and mainly change in dealer risk appetite. And we provide some evidence showing that how dealers use their futures to hedge their swap book, right? Again, to repeat, dealers are long the short dated futures and short the longer dated futures contracts. And this is mirroring what what their swap book shows us. And they tend to hedge their swap positions more tightly in the latter side part of the sample. And we also show that there's heterogeneity across dealers. Every dealer is not the same, and the heterogeneity can actually change within our sample as well. That's all I have. Thank you.
Thank you so much, Esen. That's really impressive data. So the second discussion that we have today is Lars Lochstoer from UCLA. Lars, if you can share your slides.
Okay.
Perfect. So the floor is yours, and you know the drill. You have 15 minutes. I'll give you a sign when we're at 12.
Great. Okay. So thank you very much for asking me to discuss this paper. Very interesting work. Very interesting data, and I wanted to sort of just to start out with putting it a little bit the marginal contribution here in some perspective. So there's sort of two things here. One is just intermediation and hedging and commodity and oil markets in particular is what we're looking at. And there are two very related papers. There are lots of papers on this. These are the two that I think are most related. So one is this by Atula. And so what he does, you know, he's the Atula from the Adrian Atula Muir as well. So what he does is he takes this broker-dealer aggregate measure and shows that time variation broker-dealer leverage predicts commodity future risk premiums. And so that's sort of consistent with this idea that if intermediaries have ample capital, okay, future risk premiums are low, whereas if they have little capital, future risk premiums are high, okay? But what they don't have, of course, is any sort of specific swap dealer data. This is what at very aggregate level, okay? And then there is, you know, I love Vika's comment about no discussion is complete before you cite your own paper. And so I'm going to go ahead and do that. But so what we do in this with Viral and Tarun here is we sort of look at the flip side. So if there is some market segmentation, meaning that intermediaries sort of aren't fully diversified, right? There's some concentrated risk, then that can drive the futures risk premium and make hedging costly for a producer. So a producer wants to short the futures contracts, and if that price is kind of pushed too low, then it becomes costly economically, right? So usually there's like a zero NPV to hedge, right? So this doesn't matter. But if there's this market segmentation between equity and futures market, it can become costly to hedge. What we show is that producers reduce their hedging and their inventories. Okay, so there's got real effects here. And the flip side is, you know, when producers want to hedge more, they push prices. But we only had, you know, we didn't have all this beautiful swap data. We went into the quarterly reports and we saw that the hedging was mainly in swaps, but we didn't have any swap data. We just worked with the futures. And so there was sort of a little hole there in the analysis. Behind all of this too is this notion of commodity index investing. So in the 2000s, there was this master's hypothesis, you know, wondering if the commodity index investing was driving the spot price even, certainly the commodity and futures swap risk premiums, right? And there's a couple of papers on this, but again, sort of the data just wasn't as good as what we're seeing here. So that's really sort of where I feel like this paper comes in, and it's great. We only had this old commitment of traders reports. Here we got great data on individual intermediaries, individual swap and futures positions. So really, it's a fascinating paper. Let me go through the model just to see how you're thinking. I'm going to try to do this like I was teaching MBAs. We'll see how it goes. Okay. So I'm going to start up at the right side here. This is of course it's a simple model, one period model. There's the swap market and the futures market. Let's start with the swap market. The oil producers want to sell oil, so to hedge they go short the swap. Okay. So someone's got to be on the other side of that, and that's going to be intermediaries here. They're going to be long the swap. Now the swap price is set such that everyone is happy to have zero net supply, and intermediaries and producers are mean variance optimizers. Okay, so it depends on the risk aversions. You know, if you're infinitely risk averse, you want to hedge everything. Everything that they produce, they want to hedge. But you know, at what price depends on the risk aversion, risk appetite of intermediaries. Okay, and so that's kind of what's going on in the swap market. Now, intermediaries in turn, they of course don't want to sit on a big, or don't necessarily, it depends on the risk aversion, but they don't necessarily want to sit on a big long position. So they're going to turn around to the futures market on the left-hand side here and hedge their position. Okay. How costly is it for them to hedge the futures? Well, that depends on the risk premium, or a demand from index investors, which are long futures, or some other speculators. Think CTAs, okay, commodity trading advisors, hedge funds, etc. So this is really a segmented market model, right? Where somehow it's costly to hedge because there's this localized demand curves that sort of move. So if you try to hedge a lot, the price moves against you. Okay, so that's the key thing. Now, the main questions that I understand this paper are: number one, what's the size of the swap market, right? Well, the size of the swap market clearly is going to go down if intermediaries are less risk tolerant. If they don't want to take on any of this risk, it will go down as long as it's costly to hedge it. Could be basis risk or it could be costly to hedge. If it wasn't costly to hedge and no basis risk, they wouldn't care, right? But if you have this market segmentation, it might be costly for them to hedge it. And so their risk aversion means they pull in their positions. And of course, the opposite happens here. And the swap market is, again, increasing if it is cheap to hedge. So you see that there are these linkages between these markets, which I think is really interesting, and that's really the strength of this paper, and that's what they're going to look at. So the model implications are the size of the swap market, and so I think the two first points I talked through, I hope that was okay. It's the size of the swap market is decreasing in intermediary risk aversion, right? They're increasing in producer risk aversion. They really want to hedge a lot. Decreasing in future market speculator risk aversion, and increasing in index investment. And then they're talking about this basis risk between swaps and futures. There could be some latent, the model is a one-period model, but in reality, we have the most liquid futures are in the short end. The producers want long-dated swaps. Okay, so there might be a basis risk there. And the bigger that one is, the less efficient is the hedging. Okay, so the hedge ratios is the second question. Is how much do intermediaries hedge in the future markets? Well, it depends on all. I would really talk through the same intuition here. If hedging is expensive or not efficient because there's a lot of basis risk, they hedge less. Okay, that's it. Now, in the data, we know there's a more complicated structure. So when we went through this paper, when we went through and looked at the quarterly reports, we knew that some hedging was done in options. So and the option markets are involved. But it doesn't make a lot of sense for an intermediary to, if you want to hedge a swap, the classic hedge is futures, right? That's what we learn in the textbook. So the option part isn't that big a deal. And in fact, they find that index investors often also use short-dated swaps, not futures, but they're short-dated and really correspond to the swaps. I don't think that part of the model, I think is totally fine. What I will comment on as we go along is that a lot of the interesting analysis is about maturity transformation and different maturities. So the model falls a bit short, right? When it's a one-period model and you're trying to get this, there's these different maturities going on. So the findings are that intermediate risk aversion matters. It's just a more refined. I think we have lots of suggestive evidence in literature. It's a little bit more refined evidence on this. Swap book size decreases if intermediate risk aversion increases. And I'm very pleased to see that with higher default risk and producers' propensity to hedge, the swap book size increases. So that's very nice. One thing is none of the other controls, the index investment, expected production or funding, et cetera, matter sort of statistically, or volatility doesn't seem to really get in there. So that's I'll comment on that. Intermediate hedging, they use short-dated futures. In latter half of the sample, hedge ratios are closer to unity in absolute value. Okay, they might be -1. Consistent sort of with this idea that they want to hedge better or more, take less from basis risk. So I think it's a very interesting paper and data. Some of the most interesting parts are just the plots, okay? And I think that's totally fine. This is a first look at the data is what you should do. So let me just go through these two plots you've seen, and then I'll talk about two plots that I think are super interesting that somehow ended up in the appendix. And I would encourage the authors to bring them back into the paper. So the first part is on the left here. The dark gray is the swap positions for sort of net dealer swap positions versus the producers, right? The dealers go long, the producers want to go short. So the dealers are long here. The light gray is the index swap. So the index investors go long, so the dealer has to go short. Okay, so this all makes total sense. It's interesting here to see how in the latter half of the sample, you see the shift up that producers really have wanted to hedge more and index investors have wanted to go long more. So you see that the net position, which is the black line, has gone from slightly negative to positive in this latter half, okay? And then on the right-hand side, you have this really cool plot, which is, well, that's mirrored by an offsetting position in the futures market, okay? So whatever net positions they have, they hedge, you know, in the futures market. And this is sort of on a delta basis, this thing. Again, I think we kind of knew that. We sort of knew that was happening, but we didn't have the data. And so I think, you know, it's very nice to have it sort of shown the quantities and to have it established as a fact. So in terms of this is not in the main part of the paper, but I think this is very interesting. And these are just two of the many proxies for intermediary risk aversion. The first proxy is leverage, you know, so intermediary leverage. So this is across intermediaries. So we have different percentiles here. What you see is that there's a decrease in leverage through the sample, okay? And it's a trend as far as I can tell, right? On the right-hand side, we have commodity dollar value at risk. So how much value at risk does the dealers take in the oil commodity markets? And again, different percentiles. But again, this is fascinating, really strong. It is no doubt that these guys are taking less risk in the commodity market. Okay, I think you don't need a regression, right? I can see this, and so I think these should definitely come into the paper. That's an easy comment, right? Whereas the tables, you know, the tables show the same, but you know, the picture to me is easier to digest. So let me maybe have a couple of comments here. Overall, I think this is very interesting data. They say this in the abstract. We present evidence that dealers hedge bespoke contracts. These are the, you know, we're talking about now the producers, the long-dated contracts, with standard liquid instruments and face basis risk. And the idea, I think, behind this is that the hedge ratio is sort of closer to 1, means that they're getting less so that they're sort of making a tighter hedge. So I wanted to first make a point. So to be clear, in the model, and I think in the real world, there are two sources of basis risk, okay? One is that the swaps potentially not conditionally spanned by the futures, or certainly unconditionally. You know, there could be some difference in the two markets, making futures not able to fully hedge a swap position. And the second notion of basis risk is also in, and I say that because I think a lot of people, when they think basis risk, they think about number one. Number two is that dealers might choose to not hedge, right? They might choose to leave the position somewhat open in order to make some money on a risk premium. So first of all, this difference is not particularly clear in empirical evidence exercise. I lack a little bit of a null hypothesis. And so let me talk about the first part. This might be true that there's basis risk between the short end of the futures curve and the swap contract, okay? But I'm not sure how big it is. And it would be nice to have a null hypothesis for what would optimal hedging look like, right? So think about a two-factor model of the oil futures curve. So Eduardo Schwartz have worked in these models. Pierre-Colin Dufresne has, I think that's the three-factor model of the oil curve. But the idea then is that, you know, if you have a two-factor model, then in theory, okay, you only need two futures, right? Two maturities, like 3 months and 6 months, or 1 month and 3 months, to hedge any maturity. And of course, that you might have a dynamic trading strategy, so the hedge ratios might change over time. So that's why, you know, I'm not saying you're wrong at all. I just have no idea, like, you know, what is the null hypothesis for how, if you were doing that type of hedging, what would the hedge ratios look like in the short end and the long end? You know, and if they concentrate in the short end, what might it look like over time? So I would like to know a little bit more about that, so I could really think about, you know, I think I agree with your conclusion. It's two. It's that the dealers used to choose to hold more open, and now they do less. But this was a little unclear to me.
Lars, you have about 2.5 minutes left.
Yes, great, thank you. So here's the model has sort of partial support. So what they find is that when they look at the size, the dollar size of the swap book, okay, the variables that are positively related to that very strongly is the amount of equity the dealer has, and the risk tolerance, which is a bunch of proxies. And proxy could be leverage, one of them, right? And then the other one, so that's kind of consistent with your story. The other one is that producer hedging demand as positively related to swap book in the way we would so this is very nice, kind of. But you know, we look at index investment, production forecast, and volatility. They're not significant by and large, and sometimes the signs puzzle me. Okay, I would, you know, it would be nice if it was possible. I almost spilled my coffee there. It'd be nice if it was getting excited. You know, it'd be nice if it would be possible to sort of make this all come together. And I was just, this is a boring comment that I might be off here, but you know, the empirical design, I always feel uncomfortable when I look at dollar numbers, even if you take logs, right? Because you're very persistent variables moving in the sample, and it's a pretty short sample at the end of the day. So I'm wondering if, you know, if everything, you know, you got dealer fixed effect, but still you're sort of picking up size and there's persistence. So maybe do some of these regressions and changes. I don't know if you've done it. Maybe that helps kind of make things align a little bit better, and hopefully everything starts happening. So I think I'm running quickly out of time here. In table 3, you have this finding that the commodity VAR decreases over the sample. I mean, I can see that. You know, I showed the plot. It's like it goes like that. And again, it's sort of I'm not sure exactly what the question in this table is answering. I see that the swap book is about the same, but that the amount of risk taking goes down. I think that's the point you want to make. You can make that point in a figure. Again, I think that would be a little bit more salient. And I'm not sure about the econometrics again. I mean, there's all this, you know, putting in a trend and, you know, all these very persistent variables. Maybe do it in I'm not sure. So I think maybe a test is that maybe changes in leverage correlate with changes in the commodity VAR. That would kind of be interesting to see if there's something there. So I just wanted to highlight that. I didn't quite get there. So I think sort of the data is very interesting. Further support, I would say further support for intermediaries affecting asset prices and the cost of hedging. There's some market segmentation. The commodity dealers sort of hedge index and bespoke swaps in short maturity futures mainly, but also along the curve, okay? So since I'm running out of time, I'll just say the following. Sometimes I feel like there's too long of a distance between the model and analysis. And I understand the model is just for motivation, but a lot of the really interesting stuff in my mind is about maturity, you know, spectrum. And when you have a 1-period model, obviously you can't talk about that. And you know, I would be super interested to see if there's demand at different points of the curve. Does it affect the futures curve? Does it affect the slope? Does it affect risk premium on different parts? And so those things seems like you're right there. You have the data to really say something interesting. And so I think both model and the data, that's where I would push more. But other than that, you know, I think it's super interesting, and thanks for showing us this data.
Lars, thank you so much for the discussion. Esen, you want to take 2 minutes to kind of respond before we move on to questions from the floor?
Sure. Yeah. Thank you very much. I think your comments are all spot on, and I agree with that. I'll sort of go in reverse chronological order in a way that there is a mismatch between the theory, the model, and some of the empiricals, at least the stories that we're trying to sell in the paper. And this one, I'm going to turn to Scott. He's the one who wrote the model. See if he can change the model to make it more dynamic. So I'm just going to leave it to him. I agree. Sort of things like, you know, table 3 can be done much easier. The story can be told much easier in a graph. So we will definitely take that into consideration. And you know, I agree that the basis risk, the way we interpret it is one way, but there could be other interpretations of basis risk. And we'll look into these 2-factor models and see if we can get some sort of a different, at least a test of the basis risk, what we're looking at, what we're seeing here. And also thank you for saying, you know, that some of these, the leverage, cumulative R, the graphs that are in the appendix, you know, sometimes when the paper gets too long, you're not sure, and I've gotten comments that the paper is too long in the past. So but it's great to hear that these are interesting graphs that will definitely bring them into the body of the paper, and then and we think it will help us tell the story better. So overall, thank you very much for all your comments.
Thank you, Esen. So we have about 5 minutes left. So again, I'm inviting you to kind of raise your hand in case you have any kind of additional questions or comments about the paper. Don't be shy.
Oh, hey, Patrick.
Hey, Fabrice.
Hi.
Good to see you.
Great to see you. Yeah, I have a sort of question / comment, and I guess it reflects my lack of knowledge in that area. Those producers, when they hedge with dealers, they use commodity swaps. I'm speculating that those swaps are not collateralized, or they're just one-way collateralized. In other words, the commodity producers don't post collateral to the dealers. And so when those dealers do their CVA hedging, I guess, they have two ways to CVA hedge. They either trade the CDS on their counterparties, or they under hedge their swap position in the futures market. So I'm wondering if some of the kind of hedging decisions that those dealers are taking have or not anything to do with sort of the one-way collateral posting arrangements that they probably have with those commodity producers, and the fact that maybe they're unable to hedge through CDS the credit risk of those producers, and therefore they under hedge in the futures market.
Thank you. As far as I know, we don't have really good data on how these swaps are collateralized. And I know from a different data set that we collect after Dodd-Frank that some, there can be, some swaps can have no collateral, some of them can be one-way, some can do two-way collateral and all that. But as far as I know, in this data set, we don't have, because we get a monthly in aggregate format, we don't even see actually the sort of the tenor of these swaps. So we don't have that information, unfortunately. So again, going back, we don't also have the data going back to this period to even see what the CDS looks like. So it could be what you're suggesting could be the case, but I'm not sure something we can test in data. Does that answer your question?
So Scott is kind of zooming in here. So Scott is kind of answering. I'm not sure if his microphone is working because he's not unmuting. Scott is answering that the producers generally borrow money from a syndicate of dealers and they trade swaps with some of them. So perhaps that kind of helps shed additional lights on Fabrice's question. But also for Scott, I think if you do have a microphone, feel free to unmute yourself and to comment.
And also just full disclosure, Scott is my boss, so whatever he says is correct.
All right, so
I don't have a lot to add there, but they do have complicated arrangements with the collateral. It's typically not posting of collateral from the borrowers, but it's wrapped up in their borrowing arrangements. But the CVA hedging, that is something that seems to be important and seems to have evolved over time as the regulations changed. But we haven't been able to really drill down onto that yet.
all right, so I think if there's no further question, I would pass on the floor to Christian. I think who is eagerly awaiting